Is this the stock market bottom or just the start of a bear market rally? We're going to be discussing that in today's monthly and weekly recap episode of the Stock Market Brief Show. My name is Michael Silva. If you're new here, welcome to the channel. If you like this type of stuff, consider subscribing. And for those of you that always show up, make sure to hit that thumbs up button. It's greatly appreciated. Let's go ahead and get into today's episode. All right, everybody, welcome back. We're going to start off here on the dashboard. There are going to be timestamps in the description below, but I'm going to tie everything in this video together from beginning to end, and the end is going to end up right around the bottom finding indicators that I use. So let's just go ahead and hop right into the dashboard. I want to just call out today's price action on the 5-minute time frame. Wow, if you were watching the market today, absolutely incredible. First off, we started off pretty severely down. And today I was looking for bottoms to catch. I did not expect a move like this to take place, but I did find some bottoms to play, whether it was Tesla, I played SOXL, etc., a couple of them. But then more intraday, we kind of came up, chopped around, broke down here, which was definitely a bear trap right before just an explosive squeeze to the upside, getting this chart very overextended. And a lot of people believe that coming into Friday, depends on how Friday's close is, that's typically what you're going to see follow into the next week. So next week is going to be next month. So was this just kind of a month-end markup into January? And is February we're going to see kind of that rally continue? Well, we're going to be looking at the risk ranges and everything in today's episode, but just absolutely incredible move today in the SPY. Now, if we look intraday, what was the big performer? XLK was the top leader. Why? Well, Apple reported earnings, did well, and it just kept on ripping. If we look at week-to-date performance, XLE continues to be right there at the top. XLK made a big impact mainly because of today's performance, dug itself out of the red. And if we look at month-to-date performance, everything's in the red except for energy. Energy is up 17% in 1 month. So month to date, or I guess it's in the month of January, is up 17%. That's a huge month. I wouldn't be surprised to look at this and to see a potential record there. Maybe not an all-time record, but I got to go check that out. If we take a quick look at relative strength of the 11 sectors, clearly, we're looking at a 4-week tail length, right? I like to look at the ones that are in the leading quadrant or in the improving, kind of curling themselves over. And you can see here just a big, thick green line going right into the leading quadrant, still there. Energy, consumer staples, and XLU and XLRE is still there too as well. The tails are thicker on XLP and XLU, so it still tells me that there's defensive posturing taking place in the markets at this particular point in time. Let's take a quick look at the candle glance here of the 11 sectors that make up the S&P 500. I have these stacked rank. You can see from descending order from the RSI indicator, and XLE is obviously clearly the leader. It does have a small little negative divergence. Then you see consumer staples. There's actually a nice little trend line right here that we can potentially watch for a break to see further upside. The same thing goes with utilities. Being that these are more defensive posturing, these are going to be ones to watch as we're still within this environment. If we do get a stock market bounce, they might not perform as well as the S&P 500 or tech and some of those names that have been very, very heavily just beaten down. However, if this is a bear market rally and it does turn back over, I would expect these to continue to outperform the S&P 500 and be one of these relative leaders here that we just recently went over. Not much else to point out overall on this specific chart, so let's just go ahead and hop into the monthly timeframes to give you a bigger bird's eye view of what's going on in the markets. So the S&P 500 on the monthly time frame, it was down 7%. Oof, that is not the greatest start. And actually, when it was down more towards this range, I was kept on seeing news articles basically showing that this is the worst start to January of a year in history. Now, I don't know if that's the case now as it closed up, but I can still imagine that this is, up there in probably one of the worst starts to a year. And something to really call out here on this monthly time frame is the bears got control of the 5 EMA on the monthly time frame. We have a bearish engulfing candle, and the break happened on some higher than normal volume. We haven't seen this type of volume for quite some time. So this is going to be really one to watch. Now, a couple of things that I want to point out is clearly a negative divergence on a monthly time frame. The PPO indicator here is still trying to curl itself over. It looks like it's going to be a bearish crossover, especially if we get some more downwards momentum in the price action here. So, you know, this could get nasty, but just keep in mind, like, where did we bounce from? Well, we bounced from around 4,200, which is the 23.6% fib retracement level. And we started to recover, right? But we still closed below this candle, below that candle. So we have a lot of repair work to do, is kind of why, you know, we got to still be on our toes in this environment. If we look at the NASDAQ 100, this was down 11.43%. I know a lot of people like to trade tech stocks. They're highly liquid. Apple did great today, but holy moly, that's pretty rough. That's very rough to you know, for starting off the year being almost 12% down. And, you know, I think from peak to trough, it was almost down 20%, which is technically bear market territory. I know the NASDAQ Composite and IWM did, but you can see here, we gave way on that 5-period moving average, broke on big volume. We do have that crossover that took place. As well. We did talk about this on the previous month, and we talked about that hanging man candle, giving us a little bit of a warning, but we needed confirmation. Well, we got that confirmation. Where did we close? We closed right on that 23.6% fib level. That starts giving way. We start taking out that low. I mean, it's more than possible to start looking at that 38.2 fib level on this monthly time frame. If we take a look at the IWM, a clear breakdown of this long-term trend line. It was going for about a year, over a year here. We gave way on the 5-period moving average. It is now declining. We saw the negative divergence. We saw this crossover. Where did we tag? We tagged that 38.2 fib level, and we're starting to see it bounce. Now, these markets are very, you know, they're heavily sold off already. You can see that in the percent of stocks above the 200-day moving average. I show that chart, you know, frequently. To see bounces take place, completely normal. We just need to be careful to make sure that they're not just a bear market rally, because bear market rallies, they'll rip up, they'll bring more people in, and they can easily hit into a previous area of support and come right back down. Okay, so we got to take an approach to the markets that's very tactical. If we take a look at the Dow Jones Industrial Average, this one was only down 4.44% for the month. So this one's holding up rather well compared to the other indices. But just look at the candles here. It seems to me like distribution, where it goes, you know, big red, big green, big red, big green, big red, and it's just chopping back and forth with some large range candles here. Negative divergence, and it looks like a bearish crossover is taking place too, as it stands right now. So if we start breaking down further into February, start looking at that 23.6 fib level to potentially there bounce from. We'll continue on. Let's go into the weekly time frame, and before we hop into the risk ranges for next week. If we take a look at the SPY, these are going to be a little bit more quicker, but I just wanted to call out, you know, we closed basically, it was pretty nasty week, right? Very nasty week. And then we closed right there on that 40-week, 200-day moving average. Negative divergence did play out. This hammer candle, right, that big rally today helped out a lot on some big volume, okay? So there's a strong possibility that we can bounce up, right? And we'll prepare for that on the daily time frames when we start talking about the risk ranges. Now, if we take a look at the Qs, right, the Qs were down from peak to trough 18.3%. That, you know, but then it started to recover. Nice hammer candle formed with some big volume, and it got back above slightly that 350 area on the weekly time frame. So yeah, some massive sell-off. I mean, would you be shocked to see a bounce up into a higher range right here? Not at all. I would not be shocked at all to see that. Now, if we take a look at the IWM also broke down here. We talked about this on this candle, and this right here gave us the heads up that we could be seeing further downside. That's on balance volume. Now, this candle right here, it's really a lot of indecision. The IWM, yes, I can see the potential for it bouncing, potentially back up to 210, but my focus isn't quite as much on small caps at this particular point in time, given that they've been significantly more weaker, and this has entered into that bear market territory. So there can very well be further downside here. I'd rather go long, which I am long right now. I have a full-size position in the Qs right now going into next week. Let me actually, I'll discuss that here momentarily, my full-size position on what I plan on doing. Let's take a look at the DIA. These are the levels that I want to watch. It's about 328 to around 331. If that starts giving way, this zone in here, then I'd be a lot more careful, especially if it breaks on big volume. But you can see it acted as support, started moving higher. We did close below all those key moving averages as it stands right now. Let's hop into the risk ranges. Okay, so what can we prepare for going into next week? This is an important section here. Okay, so we're looking at the SPY. Holy moly, volatility isn't going anywhere. Okay, so now going into next week, it's pricing in about a $13.83 move. That is a bigger range than the previous week. The previous week, you can see it right here, is highlighted in light gray, and then down here in light gray, and you can see we actually came down, overextended, we came back, we touched it, we tagged it again pretty much today, and then we started to recover. Where did we close? Basically unchanged for the most part on the week. So you know, we close is a shave-handed candle. You know, these type of candles, if Friday follows through into next week and we do get a pretty, you know, strong move to the upside, I can see 447.50 potentially being an area of resistance to 450. Sorry, 447.50 to 450, that kind of zone in there, because it was prior resistance and then prior support, and it can become, once again, resistance again. Now, if we get some crazy move, that'd be up to 455 right there from down here, so it can come all the way back up. But keep in mind, like, we've seen it where in a week it can hit the bottom and it can hit the top. So, like, expect volatility. I'm not predicting for that to quite happen. You can see here that it's been chopping around. It's been looking like it's trying to find itself a bottom. But, you know, it's a very, very difficult environment, especially when volatility is as high as it actually is. If we take a look at the Qs, I'm going to walk you through kind of my trade idea here. So, for example, well, not for example, but let's first talk about the risk range and then I'll go over it. So $14.1 expected move there. That's the risk range that we're looking at. That is bigger than last week, right? So the light gray was last week, and what did we do? We came down through it, but the price came back in, and we tagged it once, we tagged it twice, we tagged it 3 times, then we tagged it again, and then came right back up and finished flat on the week, which we discussed in yesterday's brief. So finish flat on the week. Now the risk range is even bigger than next week. You can see it could come up to around 365, which is where that 200-day moving average, where to the low side could potentially go to. And remember, it can always undercut these. These aren't support and resistance lines. They're just important lines to the overall options market. And we've seen in previous times that when we get a little bit outside of the ranges, you know, it could be potential good contrarian type trade, or you know, if it gets up to the top end, I've seen people take profits and or, you know, position short. It depends on your type of strategy, but let me walk you through mine. So first and foremost, if we do start bouncing, you got to pay attention to the volume. All right, so first, you know, we have a low, a higher low, you know, and then we have a high, a higher high. So this could very well bounce, right? It could be even steeper, right? It could be significantly steeper. And if we're noticing volume really, you know, head down while the market's going up, that's pretty bearish in my opinion there. You want to see volume obviously increase on the way up with price action, and then when it comes down, you want to see, you know, volume to be a little bit less while price goes down. Now, when it starts diverging, that's when you have a little bit of a problem. Now, do I think that it's possible to get up in here? Well, I took a full-size position right at about 445 to 440. I'd have to look, but somewhere right around here before the explosive move took place towards the last, you know, part of the day. It was something that I was looking at, something that I posted on Discord, and the follow through right here leads me to believe that we can see a continued move. Now, I want to just call out the risk here, okay? Because a lot of people, they focus on, well, what if you're wrong? And what if I'm wrong? It doesn't actually matter at all for the most part, right? I'm taking a trade. I already know if it goes wrong in my favor, what happens. And that's how you got to set up your trade. So on this trade specifically, okay, I'm taking a full-size position. That's 25%. Now, I entered in to a point where if the price comes down here below 335 to around 334, I think it is, and I get stopped out, I'm going to lose on my trade 4% of a 25% position. That right there is only 1% of my portfolio. Okay, so the reason why I took this trade and took a full position is because, one, I'm completely fine losing 1% of my portfolio on a trade to try to catch a counterbounce. Now, we saw the strength, and that is why I'm kind of stepping into this. I saw the range expansion, so if price does come up here, best believe that I will be removing a large portion, maybe even before that, a large portion of that full-size position. Because if this is just a bear market rally, I don't want to all of a sudden that turn into a losing trade. Okay, so I'll take some profits if we bounce up. If we come down, I'm losing 1% of my portfolio. Nothing crazy, right? But also to note, if this is a bigger move and we just rip right up to 380 or even higher and we just see some crazy melt up, I have exposure to the market. And that is most important, is to have exposure. Navigating this market here in January has been extremely difficult for swing traders and investors. It took me the first week and a half to 2 weeks to basically have my main positions that I was in get all stopped out. I was down to around minus 2.5%, which was still actually outperforming the S&P 500. And then I had to convert my trading strategy into more intraday scalping. And then I was able to basically just get all of that money back to be slightly down to basically flat for the month of January in my larger portfolio. Okay, so it was a very difficult environment to navigate, but to be down, and I'm rambling on here, to be down, less than a percentage point on a month where, you're down this much in the Qs, and this, that was 11%, the SPY was down 7%. To be down, or to be basically flat, is it's very good. And if you're positive on the month, absolutely is a great job right there. Now, let's hop over to the IWM. Kind of took this one a little bit longer than I wanted to. 8.62 expected move that can bring us up to around 204 to a low end of around 185. And think about it. So everyone was excited about this move today, right? But if we just go right up to 205 and we're looking at this chart, okay, does that look like amazing to you? I mean, does that like give you confidence coming right up to 205 that all this trap supply up in here, is cheering for that little move? I don't know. I'm not convinced yet. I need more price action and more confirmation to get excited about something. Let's take a look at the DIA. Closed right around that 200-day moving average. The range here, pretty large. $9.65 expected move. If we get the upper edge, that would just about close that gap that's lifted right there. Now, this one is forming a bear flag. You can see. Big pull to the downside, right? Increasing volume, starting to bounce on declining volume right here. So if we get some stronger moves up, right? If it keeps on drifting up, it's going to look more and more defined as just a bear market rally type of bounce, and this could all end up being distribution. So don't rule the risk out yet. Don't get so excited about a single day in the markets, right? Everyone was crazy excited about this day right here as it found a bottom and ripped right up. They're like, yeah, bottom's in, right? We don't know yet. No one knows. So you can't pretend like you do know. Let's look at commodities very quickly. Gold continues to get obliterated while the dollar breaks out. We'll go over that here momentarily, but we're still within this channel. Nothing to report at that particular time. If we take a look at oil, oil is still holding up, but I mean, it's looking more and more kind of nasty. Like today, for example, it was the worst performing sector, right? So if we go to today's performance, XLE was at the bottom. So energy stocks performed not that great. And meanwhile, oil, the price of oil and the moves in oil, definitely dramatically helped that sector. And you can see here, it's putting in a couple shooting star candles, negative divergence, price percent oscillator here. Looks like it's about to start curling over as the histogram's dying off. I mean, I am still looking at USO as a potential short. I just haven't got the confirmation yet. I also, by the way, by short, I don't mean like all the way down to 58. I mean like if we get a hit to the downside, awesome. But then I'm going to start looking for long positions because energy has been a very strong player so far year to date. And if there is, a 50% retracement of these current moves, I want to be looking to see where I can actually take advantage if there's another leg up. Let's take a look at the dollar. Dollar up slightly on the day as it's breaking out of this trend. So the dollar's bullish right now, and the dollar's bullish. It's not good for the S&P 500. It's not good for commodities. Is this going to hang up there? Are we going to come down a little bit? And is that going to help relieve the S&P 500 and potentially, other commodities? Perhaps, as you can see, that's kind of a, a little bit of a topping type indecision candle. You can tell by the range of these candles expanded, and then the range of this body got very, very narrow there. So yeah, perhaps that helps out if it pulls down and we start to see this continued, potential rally into a previous area of resistance. Let's take a look at bonds and yields. Not giving us much information. Just notice how contracted these are getting and have been getting from previous expanded area, which makes the curve flatter and flatter. It's pretty flattened there for the week, right? So 0.63 on the 10s and 2s, 0.46 for the 35. This has been the most reliable indicator, and it's 100% accurate in predicting recessions in the economy when they invert. So we'll keep a close eye. The TNX, the 10-year yield, up 2% on the week. It's kind of just holding around that 200-week moving average. If it starts pulling back, that also might help out the tech sector to continue to see a little bit of a rally here. But we'll see as it broke out of this inverted head and shoulder pattern. TLT, I still think that this could be a potential good trade to the long side. We have a nice little hammer candle right here after pulling down. The price percent oscillator looks like it's trying to curl itself back up slowly and surely. The risk side and the downside to this is this was a potential of bear flag. But keep in mind where it hit, 140 was the level I was looking at. That's previous area of resistance, previous area of support, and we're back there again. So, that could always set us up for, a run right back up in the TLT. Now, let's talk about some risk to consider. Okay, so we talked about the ranges, we talked about some larger time frames. I gave you the bullish case for a rally, potentially all to new highs. Who knows, right? But I also, talked about the possibility that this is a bear market rally. Now, are we surprised to see a rally? We should not be surprised to see a rally giving overextended levels. You can take a look at the BP chart, right? Bullish divergence that's forming. These type of overextensions can produce bounces. So to find exposure to the market to take advantage of the bounce, absolutely 100% okay to do so. BP SPX, same exact thing. The NAMO, right, or the NIMO, same thing. It came up a little bit, right? These are overextended areas and we start to see bounces, okay? But from a risk perspective, we talked about this yesterday. This is the NYSE. When it gets below zero and it heads down, it's not always good, right? You want it above zero and you want it pointing up and heading up. But it matched in the same time as the NIMOT hitting a minus 300 reading, which is now bouncing from that area. The last couple of times that happened, boom, boom, and you can see we actually bounced for a few months, and then we started to sell off, and here we bounced up, but then rolled itself over here too. So when these readings are hit, it's basically saying it's a very turbulent market, which we're already seeing in the volatility. So what does that mean? Well, it's a risk to consider. All right. It means to protect your capital. Another thing that I want to point out here is the CPC. I use this as a buy and sell signal, but as it stands right now, it didn't update. It's the 27th right now. Okay. It'll update later tonight. And I wanted to call out that the 10-period moving average is still pointing up. And the last time that we got above 1.0 was over here during the pandemic, right? Not to say that the pandemic's happening, but during that time, you can see that the market was selling off. And when it crossed above 1.0, we saw a nice rally. Oh, no, it's okay. We're fine. We're fine. And then all of a sudden, we saw some significant damage as it continued to perpetuate to the upside. Now, we're back above 1. We saw some selling activity take place. We're right there. Okay. We're starting to see a little bit of a bounce. If we start to get a continued bounce, and this continues to perpetuate itself higher and higher, bear market rally. That would be probably most likely a bear market rally, but we would just need a confirmation we would need to get back below the low of this previous bounce, okay? So that is just something interesting that I wanted to point out. I'm not predicting for that to happen, but it is something definitely to consider given this environment. Let's talk about some bottom finding indicators here. Pring bottom fisher still pointing straight down, hasn't started curling over yet, right? These are lagging indicators, but when we get below these minus 30 readings, we've actually seen some pretty good bottoms caught, as you can see right here and here. The next one is the Cohen high-low. This one, it's reaching for that 0.05. All right, so the week closed off. This went lower. It's at 0.07, 0.02 away. When we get below it, we're potentially near a bottom there. Now, the only time that, and then you want to wait for it to cross back up, obviously, there too. But we need a weekly close below it, really, to then see it cross and turn back above it. So it's pointed out some big bottoms, right? The only time that this gave us whipsaws was during the financial crisis. As you can see, it came down, right? And then we bounced, and then we came down, and we bounced, and then we came way down, and then we bounced, and then we came right back down. And then, so it found multiple of those bottoms, as you can see through these vertical lines here across the screen, but right, there was a lot of whipsaws. There was a lot of whipsaws. So yeah, it can give us good insight, but we need to be obviously very careful, especially if you're one that thinks that a bigger crash or bigger, devastation in the markets is going to be taking place. Me personally, I'm not rooting for that, but at this point, you got to be prepared for anything. If we take a look at the NASDAQ record high percent bottom finder, we did have a weekly close below the 20 reading. So what do we need to do to feel more confident that we're finding a bottom? We need to see this turn back up through 35. That gives us and has given us good signals of moves to the upside. As you can see, actually right here, it actually came down and then just started ripping. And then right here, would that be crazy if this is kind of like what's going to happen? So basically what we're going through right now, it's pretty similar, right? We crossed down through it. It started reaching further. This little sell-off, it doesn't look like much, but it was pretty severe. Then when it crossed up through it, we saw that big melt up, just huge melt up. This is like, David Hunter's, what he's calling for is like a monster melt up before a crash. So what if it is going to do something like this right here, just to be a monster move, monster melt up before it all just completely falls apart. Now, the reason why I say that is because if you want to get all out and don't note exposure to the upside, I mean, wouldn't you have want to caught this move, right? Wouldn't you have want to been in from 99 to 2000 and catching and being on the long side of stocks? And then when you saw the turbulent market again and you got other signals that tell you to get out, absolutely, right? A lot of money could be made here. A lot of money could be lost here. A lot of money can be protected right there. Ooh, that was good. That's all I got for you on today's weekly and monthly recap, everybody. Have a wonderful weekend. Be safe out there. Excited to be back in February. Goodbye.